Good morning, everyone. Thank you for taking the time to join us for our workshop today. Please note we will be recording this session and it will be available on our website post this webinar. My name is Louise Sayers and I'm an audit partner and the head of natural resources at BDO. Joining me today to present this workshop is Peter Clock, who is also a partner in our natural resources team. Before we dive into the main part of this morning's slot, I thought I would just flag that this is a workshop, not a presentation or webinar. Therefore, we are aiming to make this next hour more interactive. As such, we'll be running a number of on-screen polls and are looking to pose some questions to you as participants. We think these will be useful for us to share our thoughts around. Please participate in the polls and feel free to contribute your thoughts to the questions using the hand raise function in Teams. We will put all participants on mute now to prevent any further background noise. I do hope you find the next hour useful and thought-provoking. The volatile events of 2020 have impacted all natural resources companies, but in different ways. The model on screen, the BDO RETHINK model, is a model which seeks to help put context to the different stages, for want of a better word, which businesses pass through as they react to issues or events, whether these are issues such as pandemics, other natural disasters, man-made disasters, or challenges such as financing, production issues, etc. However large or small the issue or event, this model can be applied. In 2020, the impact of the most recent issue the world has faced, CV-19, was significant for oil producers. The outbreak of COVID created a sudden and dramatic decrease in global oil demand, which was then exacerbated by the Russian-Saudi dispute. Eventually, these events led to the oil market collapse in April 2020. Although there seems to be some stabilisation of the market at around $50 a barrel, the consensus trend for prices over the next 5 years does not seem to evidence that prices returning to where they were pre-COVID, which in itself is not where prices had been. On the flip side, gold, the perceived safe haven, reached record highs in the face of the COVID-induced economic uncertainty. Unlike gold, other metal prices were impacted by the pandemic, primarily by the health of the Chinese economy. As China consumes around 50% of global metals, on the back of a strong COVID recovery, China's economy has bounced back from its virus slump. This has led to an increase in metals demand in recent months and thankfully translated into an uptick in prices. Whatever the impact of COVID-19 on your business, whether you're an oil and gas business, a gemstone producer, or a metals miner, the RETHINK framework will fit your business. In the initial phase of react, the phase which occurs as an issue or event impacts, it's the phase where the business has to react to the challenges it faces posed by the crisis that are ongoing. How does it survive in the short term? These short-term issues may vary from being operational challenges, i.e. shift pattern adjustments, or logistical challenges, or they may be more significant and fundamental to survival, i.e. engaging with lenders and funders to secure short-term cash flow or manage covenants. The common theme is short-term. They are the events that need to be dealt with in the here and the now. They need a reaction. If we think back to March 2020, when, as management, your days were filled with reacting to issues, dealing with problems, firefighting. Albeit we're not quite back to where we were, it does feel as though the times are different. We have a rhythm to our business cycles again. It is therefore clear that over time, as management, you will move to being in the more of a resilience mode. The business has survived, but the steps taken to survive now need to be embedded into the business and safeguarded to protect the future resilience of your business. Following which, at some point, as a business, you will be able to step back, take stock of what has been achieved and managed, and start to form new plans to once again realise the future potential of your business. This is a phase in which management and the board can take time to refocus the strategy of the business, take well-considered decisions, and make plans to once again set yourselves on a path to success. Our rethinking model doesn't just focus on one overall view of the business. It can actually be used and applied at different levels. It is possible to rethink individual aspects of your business. These could be workforce planning, your international structure, the way in which your governance committee operate. In that context, the aspects of Rethink we are focused on today is the short-term focus required for your annual 2020 reporting and the areas which you need to consider before those reports go out into the marketplace. On that note, I will hand over to Pete, who will talk about control environment.
Good morning. So as Louise said, I'm going to talk about the control environment. Now, in your minds, I'd like you to go back to March last year and remember that very short notice we had before the mass exodus from our offices. Do you remember how quickly you all had to react as COVID unfolded? And this impacted all businesses. Now, in light of these challenges, in a pretty unusual move, the regulator relaxed some reporting deadlines. And at the time, I remember that was a huge help. But what hasn't changed is the expectation of companies to maintain strong control environments and good corporate governance. So 10 months on since lockdown started, what is the state of natural resources control environments? Well, as you'd expect, I think it varies from company to company. And I've seen some really observable changes, such as how controls are functioning. But I've also seen some less visible changes in companies that, rather like COVID illness itself, have crept in and are causing real disruption. So let's start with some of those observable changes, such as how controls function. These are things like relaxed IT systems access controls, where hastily implemented changes were made to facilitate remote working. Or maybe it's reporting lines being altered as people were let go in response to companies cutting costs, which resulted in segregation of duties limits being bypassed. Perhaps surprisingly, we've seen that the biggest disruption tends to be in the companies with the best controls. And that's because these companies, by their nature, they have controls that are designed to be hard to override. And then I mentioned as well, you've got some less visible factors. So this includes how individuals within your organization are dealing with this new remote virtual world. Now, like me, you might not miss your daily commute, but ask yourself, if you're honest, are you effective working from home individually? And are you effective working from home as a team? I'll give you some examples. Okay, take your regular briefing, daily, weekly briefing that you have as a team. This is now virtual. Now, most of your teams are going to be multitasking while listening into this. And this is something they just simply couldn't do before because they were in the office and it was a face-to-face meeting. So as a result, are these messages that you're sharing, are they really sinking in and being heard? And then if you've got some parents in the room, how much are you loving the homeschooling? I've got 3 children next door and I'm feeling your pain, don't worry. And then there's the super achievers in the room. I mean, do you ever switch off your laptop when you're working from home? And are you at risk of burnout? So to help you think about these questions, I've got on the slide some questions. And these are for management and for audit committees to consider. And for management, these questions are aimed at understanding what's changed within your organization's control environment. And then having determined this, thinking about what are the mitigating actions or compensating controls that need to be put in place to fill the cracks that have appeared. And then for the audit committee, as well as understanding how the control environment's changed internally, these questions consider how outside influences have changed that could also impact your business. So, for example, cybercrime is reported to have increased 400% during lockdown. Do you know how this evolving threat is impacting your now virtual organization? And have you considered how is the additional pressure of lockdown impacting the well-being of your team? And is enough being done to support them? So moving on, we're going to have some more polls. There's going to be 2 poll questions that come up. So we'll do both polls and then I welcome a group discussion to talk about them. So first question, at a company, not personal level, remote working has, and then select one of the following. So at the moment, we're somewhere between less efficient and no change being the main reasons. No change, just creeping ahead there. Okay, we'll now go on to the next question, and then we'll come back and talk about it.
An interesting split, isn't it?
Yeah. So at a company level, it's either seems to be no change or a bit of a reduction in efficiency. But at a personal level, it's much more evenly split, almost equally between improved, the same, or reduced. And I don't know if anyone from who's listening in has got any thoughts on why that might be, or Louise, you want to comment on that?
Well, I'll give people a bit of thinking time. I didn't expect that second poll to end up like that, to be honest. I was quite surprised that it is quite as evenly split as it was. I personally thought people would be finding it more efficient to work from home. As you said, you have reduced commute time, so you get a bit extra time in your day, a bit more quiet time maybe, certainly before homeschooling. So that is a surprise to me, Pete. Any questions from the floor? Any thoughts?
It's Laura Pingree here. I think it just depends really what your exact role is, because we've got a lot of people here, I think, in fairly senior roles. So it's exactly what you say. It's that quiet time. But you know, I'm sure the people who, if we polled the same question to people who were in our teams, we might get a different response there, a different set of answers.
Yeah.
I think it impacts your is impacted by sort of how experienced you are. So if you're very experienced working remotely, you can get on with your day job, but perhaps some of the more less experienced junior people of your team, they're missing out from having that oversight that you're providing them, which sort of leads to inefficiency as they don't ask that question as quickly, that enables them to move on. So I think there's variations between that aspect. Any other comments from what people are seeing within their own organisations that they'd like to chip in and add, or we can move on?
Just a quick point.
Good.
Mark Kenton here. I just the observation. I've done a poll like this for my team, and they say they've improved their efficiency.
Sorry, you're quite difficult to hear. Could you get closer to your microphone?
Or is that any better?
Much better.
Sorry, yeah. So I've done a similar poll with my team, and they felt they were much more efficient. And then we sat back and we said, well, why is that? And it was actually a function of the point you made earlier about we've been focusing really hard on the team well-being. So we've introduced additional daily war rooms to make sure that people can raise all the stuff you'd naturally do in the office. We've replaced virtually. So I've invested a bit more time to ensure that my team feel more efficient, and that seems to have worked. So I think that's an observation I'd make.
Thank you.
There's a couple of comments in the chat panel as well, Pete, if you've seen them. Jim says, as a small company, that's the way that the business has already operated. So I guess, Jim, that the transition to remote working hasn't impacted you significantly. So you were well experienced to start with. But Martin notes that his day personally is more efficient. But again, going back to that point, that the inability to meet physically does drag in some efficiencies when you can't talk to your fellow directors face to face.
And if we roll forward a year and the vaccine's all been a huge success, and we've locked all these variants down, and the world's functioning normally, what's the view in the room of what the new normal is going to look like?
It's a big question for 8:48.
Pete, it's Jack Draycott here. Just a comment on your previous question. It kind of leads into that as well. I think that it's been rather, the remote working this time around has been rather binary. So we've kind of been all at home and not able to meet together at all. So I think that for me, that poll kind of reflects the fact that some things have been more efficient and some things have just not been possible. And Martin made the same point in the comment box, really. So I think that a hybrid is likely to be more efficient from my own perspective. But I think where we've been over the past year has been overall less efficient.
And I think we've got some comments agreeing, but if you want to ask a question to the panel, either stick up your hand or just find a pause and jump in, which was one of the questions we got.
David, do you want to ask a question about this section?
Oh, hello, Lise. Good morning, everybody.
Hi.
My question was, how do I ask a question? I'm not quite sure how this is operating. So without appearing rude to people who are already speaking, how do I put my hand up?
So there's a little hand button at the top, David, in the top line of icons. If you just press that, we'll see you glow, and we'll be able to come back to you and ask you to ask the question.
A hand button at the top.
There's a hand function. It just looks like
in
a
the
hand.
row.
Yeah.
Yes, yeah. So when I press that button, I'm being allowed in.
Your hand goes up and we can come to you and ask you to ask the question at the right time.
Oh, I see. And why do I keep being muted and unmuted? Is that my machine or is it a function of the meeting?
It's just to keep the background noise down.
I'm with you. Okay, thanks, Louise.
No problem.
And how do I leave you now?
Martina will mute you, don't worry.
Okay.
Any more questions, or should we move on to apply the rethink model to this?
Move on.
Okay. So now we're going to apply the rethink model to the control environment. And I think 10 months on from the pandemic starting, as Louise said, we've sort of settled into our new rhythm of remote working. So we're past the react phase. And on the whole, we're in the resilience phase of rethink. And I think this is characterized by teams starting to critically evaluate and test the socially distanced control environment that we work in, and where required, developing compensating controls to plug gaps that have appeared. So this virtual daily war room that we talked about, that would be an example of that. But there's a few companies that are sort of moving further on, and they're thinking in the realize phase of rethink. And these are the teams that recognize that 2020 has brought about lasting change to how we work. And they're using the learnings from 2020 to implement further change for what's expected to be an increasingly dispersed and tech-dependent world. So some of the solutions that we're hearing companies talking about are employing increasingly collaborative technologies to enhance social cohesion between remote teams, or implementing new technologies like robotics to automate business processes to lead to cost savings and reduced errors as people work from home in a remote way. So that's all I wanted to say about the control environment. And now I want to move on and talk about going concern, which is quite a big topic. Okay, so COVID's definitely led to an increase in the number of companies that are dealing with some challenging liquidity or covenant compliance issues. And as a result of that, we're being asked more frequently to explain to companies what a qualified audit report is. So essentially, if you're going to prepare your financial statements on a going concern basis, there are three opinions that could arise. So the first opinion is when your auditors determine that the approach that the directors prepare the financial statements on a going concern basis is correct. And that's an unqualified audit opinion. And a note here, though, I mean, in this uncertain world, this is a very high hurdle to achieve that. The second opinion, and this is what we're seeing more and more of due to COVID-related uncertainty, is accounts that are prepared on a going concern basis, but there is the existence of a material uncertainty which causes significant doubt. So some examples of what those material uncertainties might be, they might be, could a company obtain finance in the future? Or what's the impact of negative fluctuations in commodity prices? And these uncertainties require disclosure in the financial statements, but they're also referred to in the opinion. Now, if your opinion has got a material uncertainty in it, it's also unqualified, and that's a point that a lot of people trip up on. The third type of opinion, which does result in a qualification, is where there's a disagreement between the auditors and the company over the existence of the material uncertainty, and in practice that's rare because auditors and companies tend to talk to each other. So if you prepare your financial statements on a going concern basis, they are the three types of opinion you can receive. But there is another scenario where you don't prepare your accounts on a going concern basis, but on a breakup basis. And a breakup basis is where essentially the company is going to have to turn off the lights imminently. And in this situation, the whole accounting basis changes because balance sheet items are remeasured and they're impaired down to their realizable value. So they're the sort of different types of opinion that might arise from going concern. And now we'll go on to talk about how do you prepare a going concern analysis. So this is really difficult normally, and with none of us able to gaze into a crystal ball and these volatile markets that we have, making cash flow projections is really challenging. And to add to your woes, for periods beginning on or after the 15th of December 2019, so for December 20 year ends, there's a new auditing standard that's come in on going concern, ISA 570. And this increases the amount of work that the auditors and the company needs to do, because it encourages you to have, or it requires you to have expanded risk assessment procedures, more auditor scrutiny, as well as enhanced reporting in your auditor's report. So with this sort of happy combination that we've got, happy combination of more uncertainty and more regulation to contend with, on this slide, I've got 6 steps to help you navigate preparing your going concern assessment. So step number 1 is preparing a base case. This is a forecast that goes out more than 12 months, and 18 months is best practice from the date of approving the financial statements. It's not 12 months from the year end, it's from the date the accounts are approved. And your base case model should be realistic. So normally it's based on a budget, but if you've got quite a lot of stretch built into your budget, you might want to pare that back. It should be achievable, it should be what you measure yourself against and that you're confident you're going to be able to achieve. The second step is applying hindsight. So when you prepare a going concern assessment, it's an iterative process and it requires cash flow assumptions to be flexed for actuals and for new assumptions right up to the date the financial statements are approved. And that's different to some of the other models, because other models sort of lock themselves in at the conditions that existed in the balance sheet date. Not the case for going concern. You keep changing that right up to the date that the accounts get approved. The third area I want to talk about is financing. So the key here is that assumptions over financing should only include committed facilities. So if you haven't yet obtained these facilities, even if you're very confident you can obtain them, they should be excluded. And that's the same for debts or for hedges. Only include them if you've entered into them. Now for oil companies, there's another area I'd like to touch on in respect of reserve-based lending, or RBLs. Now this is challenging because the amount of debt that you can borrow under an RBL is redetermined periodically, and it depends on how much oil you've got in the ground, but also what the oil price assumptions are at the date of redetermination. So if there's been a change in the conditions or outlook since the last redetermination date, you need to factor that into your going concern analysis, because the amount of debt will change. And the reason that's complicated is you need to understand the bank who's providing that debt's RBL model to understand how it's going to impact the borrowings. Okay, the fourth stage is you've got your model, you've applied some hindsight to it, and you now need to think about what can go wrong. What's a reasonably plausible downside? And there's no one-size-fits-all approach to determining what a reasonably plausible downside scenario is. It's going to be impacted by the commodity that you trade in, your geographical location, and many other factors. And with so much judgment involved, what we're seeing is best practice is to perform a reverse stress test. So a reverse stress test is where you stress the assumptions in the model until the model is at the point of breaking. And this can provide really good evidence to support the conclusions that you reach. And I think this is an area where I really encourage you to have early conversations with your auditors about on. Okay, the fifth area is now thinking about mitigating action. So you've got your model, you've stress tested it down. What else can you do to sort of preserve your cash? So this includes any actions, modeling in any actions that are completely within your control. They're not reliant on any external parties. So examples of what you might want to include here could be stretching creditors, or reducing salaries, or deferring discretionary uncommitted capex. These are all items within your control that you could manage, so you can model those ones in. And the final point on here is thinking about the disclosure. So you should aim for this to provide context that support your conclusions. Okay, so good disclosure, it doesn't just clarify the going concern position, but it's really clearly details out where the elements of uncertainty are and what management plans to do to mitigate these risks. And there's some really good examples of this disclosure out in the market. So as you get to this stage, feel free to give us a call and we can point you towards some good practice. Okay, so now I want to move on and do the next poll. So get ready on your voting fingers. Okay, so for this one, tick all that apply. So starting to see some results coming in now. So about a third of you are looking at cash flow forecasting more regularly. Quarter of you are doing additional what-if scenarios. 20% implementing additional checks to control spending. Less than 10% extending credit terms from suppliers. About 6% government assistance, and 8% obtained new finances. I think what strikes me about that is I thought the lower questions, the ones at the bottom about obtaining finance, we might see higher numbers there. Certainly talking to lots of companies at the moment who are in need of raising additional financing and talking about that. And 2020 actually more money was raised than in 2019, despite COVID, in the equity markets, which is an interesting stat. How do those results? What does everyone think about those results? Surprised, as expected?
Pete, I think that the responses to the top two are very positive in terms of the longevity of those sorts of behaviours in a business. If people have seen the benefits of increased frequency of cash flow modelling and running what if scenarios, those are the kind of things that you should embed during that resilience phase. They will be helpful going forward.
Do people think this year preparing going concern models is going to be more challenging? Or I suppose it depends on what your commodity is, but oil prices, you know, difficult year last year, gold prices have been much higher. Other views that we would have expected getting new financing to be higher. What about obtaining government finance? Was that something that many companies tried, and any comments on that? So I know a few companies that have done that. Okay. Any further points before we move on to apply the rethink model? Okay, let's move on to the next slide. So, David. You're on mute, David. You need to unmute yourself, which is
okay. Is that
there we
good?
are. We can hear you.
Okay. On the 12, normally when we've had our accounts signed off as a going concern, it's been from 12 months from the date of sign off. But now I've read something quite new about the best case is 18 months. Has this always been the case, or is this a new COVID introduction?
So 12 months is what you're required to do, but the reason that companies are looking beyond that is to make sure that you don't fall off a cliff 12 months and 1 day later, which would be a bad scenario. So companies tend to look forward just to make sure that there's nothing out there that could impact it. And with the uncertainty, if that sort of came forwards, that would be a problem, which is why people are tending to look a little bit further out.
Oh, I see. So my question is, to obtain the going concern thumbs up from the auditor, does it mean that you're actually looking for is the 18-month or mandatory?
It's best practice, and I think, you know, auditors would prefer it, but that they would insist on perhaps looking more than 12 months, but maybe not out as far as 18. But I think as well, from a sort of governance of your company, to be taking that 18-month view is definitely best practice and recommended.
Yeah, I can understand that. Absolutely agree. Yes. Yeah. So is it a new COVID introduction, or something which has always been there?
So the ISA 570 is the new standard. That's the new introduction that came off, you know, partly off the back of COVID, but also some of the corporate collapses that we've seen in recent years. So it was a kind of combination of those factors, and I think COVID sped it up. And what the standard does is it really makes the auditor apply greater
pressure,
be more skeptical. Exactly. So looking out a little bit further, that's an example of applying more skepticism.
Thanks for answering my question. Great.
I'm just reading some of the questions now, some of the comments. Other people would have thought additional financing would be higher as well. Someone wondering if everyone ticked multiple boxes or just one that impacted the answers. And then a point here on green agenda. Okay, shall we move on now and apply the RETHINK model to going concern? So similar to controls, 10 months ago, you started in COVID, and hopefully you're now out of that slightly uncomfortable crisis management stage of managing your cash that you faced at the start, and you find yourself either in the resilience or the realize stage. So I think the resilience stage can be characterized by companies who now have a firm handle over their cash flow projections. They understand their cash pinch points, and they've implemented some additional controls that are reducing cash outflows. The realize stage takes this a step further, and it builds on this cash focus momentum to further develop cash preserving practices. And examples of this include improving underlying systems to monitor cash and further embedding cash excellence throughout the operations. And I think the companies that are doing this are the ones that are strengthening their competitive positions, and they're going to be the ones that are best placed for growth as we come out of this COVID cycle. Oh, Mark Kenton, responding to your comment, how can auditors become even more skeptical? Well, I'm sure you'll find out shortly. Okay, I'm now going to hand over to Louise, and we're going to look at impairment.
Okay, so I'm going to try and keep this impairment section too much away from the technical and focus more on the practical aspects. Depending on your commodity that you're involved with, this part of the workshop's either going to be very relevant to you, or it's just going to be a bit of revision and reference material. So, as we all know, determining the existence of impairment involves making assumptions about the future. It goes back to that crystal ball comment that Pete made earlier. We all wish we had one. In the current environment, what the future looks like is particularly challenging to assess, given the nature of the current ever-changing economic and pandemic situation we find ourselves in, versus the long-term lives of the assets that you're working with, 10, 15, 20 years plus. Under the accounting standards, we, management and the auditors, will need to perform a detailed assessment of the carrying value of an asset where an impairment trigger or triggers have been identified. Under the accounting standard, our assessment of carrying value when reviewing the detailed models is based on a value in use model or a fair value less cost to sell model. And the accounting standard requires you to focus on the higher of the two when you perform that modelling. Whichever model you use, there is a need for consistency of the model and the inputs that you are using in the model compared to the inputs you use in different areas of your financial statements. For example, on inputs into the impairment model under a fair value less cost to sell approach, you need to include future CapEx costs. These CapEx costs also need to feature in your units of production calculation for depreciation where 2P reserves are being used in that calculation. Again, that goes back to you need to have consistent future CapEx costs impairment and in your UOP calculation. The second area that needs to be consistent is something like inputs used into your asset retirement obligation. The life of a mine or the life of a field, those inputs too need to be consistent between your ARO, decommissioning provisions, and your impairment modelling. Another consideration that we're seeing more and more and hearing more and more about is considerations around climate change. Obviously, this is a very significant area of focus for investors, and it is increasingly so for our regulators. It's not right to say it's a new entrant on the list of things to think about when preparing an impairment model, but it is certainly a topic which is gaining more profile and is higher up the corporate list of considerations than it might have been in the past. The impact of climate change on the sector, as I said, given the long timetables associated with the assets that you're working with, has the potential to be very significant. The considerations around climate change and more widely sustainability, so if you incorporate the social governance aspects of projects and the political pressure, need to be reflected into our models. Such considerations may relate to levels of production, judgments relating to prices, what the green agenda is doing to both of those, the ability to identify and source long-term offtake agreements where you might find political pressures or local economic pressure coming into play. Additional costs to offset emissions, so your carbon credits, these all need to be factored into models. These climate change and sustainability may not be considerations that in the first instance spring to mind as being part of impairment models, but when you are looking that longer period out, 10, 15, 20 years plus, they are the type of considerations that over that time horizon will start to significantly impact your assets. They will very much have a value on the impact of the assets over the course of that lifetime. And they are certainly the type of areas and the line of questioning that we and other audit firms are seeing from our regulator. Another area of impact which has come onto our radars within the last 18 months, 2 years is IFRS 16. So for most of you, the first time that you will have applied that is for your December 19 year end. And we will be applying it going forwards. So we do need to keep considering how the carrying value of the right of use asset and the lease liability impact our impairment assessments. So there's a number of areas you need to think about when you're looking at IFRS 16 for this second year through. Firstly, which CGU do those right of use assets actually belong to? If you have one CGU, relatively easy to determine, but you might have assets that are used across different mine sites. You might have assets that work across a shared service centre arrangement that you have within the business. How you determine which CGU these right of use assets get assessed against, given that they probably don't have their own distinct cash flows, is a judgment and a challenge. Secondly, discount rates. So the discount rate that you will use in your impairment model is a post-WACC adjusted discount rate, whereas for the purposes of the accounting standard for leases, you're looking at the implicit rate of interest that's included in the lease, or an incremental borrowing rate if you can't find one based in your lease. These discount rates are different, really different. And if your business model is structured around a significant part of your operations being effectively leased under the accounting standards, there can be a material difference in terms of the effect of those on the impairment model versus the right of use asset carrying value. And then what do you do with your lease liability? Does it come into your assessment of the cash generating use asset base, or does it not? If you are using a value in use model, lease liabilities are excluded. You just can't include them, and it's very clear in the accounting standards that they are effectively a form of financing and should be excluded from the assessment of the net assets considered from a cash generating unit perspective. For fair value less cost to sell models, you can include them, but you have to be able to demonstrate that they are a necessary part of how the business operates, and a hypothetical buyer, not yourself, would actually also include them in terms of their arrangements. So impairment, I've spoken about impairment really relating to your exploration assets, your development assets, your production assets, those non-current assets that sit on the balance sheet. But impairment of assets also relates to other areas as well. Other financial statement areas are impacted. So these could be your investments in subsidiaries, associates, joint ventures, all have cash flows derived from underlying CGUs. But you've got to be careful when you're looking at these sorts of assets that you don't lump them together and end up using success or positive cash flows, positive NPV models in one asset to cover up a potential impairment in another CGU. Inventories. COVID-19 has brought some practical challenges just about counting inventory, but it also brings challenges around looking at the valuation of inventory. Commodity prices are a challenge. If there's a risk that inventory may be impacted by future commodity prices, there would possibly be an impairment there. And then receivables. Under IFRS 9, the expected credit loss model has to be applied to look at receivables and the risk of default of a debtor or a debtor book. In a COVID-19 environment, that risk is obviously potentially increased. Natural resources companies tend to have relatively low debtor days, so that inherently reduces the risk of expected credit losses from third-party receivables. However, the difficulties in cash flows that you might be experiencing within the business might indicate that for intergroup receivables, there is an increased expected credit risk. and therefore again a potential impairment of your intergroup receivables. I think I could probably talk about impairment of assets for a long time, and those of you who are my clients have probably heard it all before. So we'll move to the next poll, and then we can take any questions and share any observations on that poll. Thank you, Martina. So this question is, in respect to climate change and impairment analysis, which statement best describes your organisation? There is one more at the bottom if people haven't scrolled down the sidebar. You just want to check all the options. Okay, as the votes come in, that initial view isn't changing. Most people are saying we've not yet considered the impact, do not know how to factor in. As I think from our observations of having spoken to companies in the last year, I think that would have been our view of how this poll actually turned out. It is a challenge. It is an area, particularly when you say those words, climate change, that for us in our sector we don't naturally think it actually impacts our business. But as I described, there's a number of nuances around pricing, the political challenges you may face, getting offtake agreements signed up for long term, which do need to be factored into those models. If anybody needs help, you know where we are. But does anybody have any thoughts or kind of questions that they would like to raise on those results now and share with the meeting?
Louise, it's Jack Draycott again. Just maybe a question. So I know that I'm from BDO'S as well for everyone, for benefit of everyone else. I know that it's high on the agenda of the UK Financial Reporting Council and other kind of regulatory bodies, the whole issue of climate change. And I think that we'll see this evolve, and there'll be more guidance and documentation and strategy coming out over the next few months and longer. But do you have any views on that kind of disclosure impact in the short term? I guess one of my views is that, you know, even if there's not necessarily a negative impact of climate change, or even if it's difficult, which is the kind of most common answer, I think the expectation will be more disclosures in accounts, even if those are that, you know, it's quite difficult, or companies have done their best, or, you know, by including recent commodity prices, to some extent you're already factoring in the market's view of the longer term impact. I just wondered whether you had a view on that.
I do, and you know, David's flagged in the chat panel that when some new disclosure requirements come in for the larger end of the market, there will be more informed responses to these sorts of areas of focus. But even where there's no requirement to actually include specific disclosures that are dictated by codes or regulations, there is a recommendation, and we're certainly talking to our client base this year, that people should start sharing their thinking about where they are in terms of how they incorporate the sustainability, climate change considerations into how they operate. Investors want to know about that. When you're on roadshows, some investors won't fund you unless you're very clear on that side of where your business sits. So our recommendation has been to start the journey in this year's annual report and make some narrative disclosures.
Interesting article I read a week or so ago in relation to Glencore, so coal miner, and they talked about the different levels, level 1 and level 2, which is the sort of pollution that they make directly or their supply chain make. And actually, as a coal miner, those weren't particularly high. It's the level 3 type emissions, which are the emissions that the end users who buy your product have. And they said they wanted to become carbon neutral in the future for all their different levels, including level 3. And their strategy, they outlined a bit of a strategy to do that. So that's sort of very far forward thinking on how you do that. So, I mean, you don't naturally assume a coal producer is going to sort of be leading from the front on these green matters, but an example of how companies are doing it. So I think it's a space that's rapidly evolving, and keep seeing what's happening out there to get some best practice.
Absolutely. So Martina, can we just move on to the Rethink slide? Thank you. So how do we relate to what we've talked about to the Rethink model? In the last reporting cycle, many companies just had to react to uncertainty in the economy and a financial reporting regime. There were impairments taken given the significant drop in commodity prices, and there were material uncertainties included in audit reports highlighting the COVID-19 risk attached to impairment considerations. But now, as I said, we're nearly a year on, and we should all be thinking about impairment differently, using the lessons learned from last year, but also using the rethink phase of resilience to think about how we embed the changes made in the business into our models to assess whether there are any new underlying impairments in our asset bases. A key area of focus this year, picking up the point we talked about on disclosure, will be ensuring we fill any disclosure gaps in the annual report. The shareholders and regulators alike will be looking to the annual reports for information, justification, data, and supporting analysis to help them understand that the stance that you as businesses have taken on the assessment of the carrying value of your assets. Over-disclose rather than under-disclose to avoid any criticism and challenge. In the longer term, as companies move towards the realise phase of the Rethink model, businesses should be beginning to think about the impact of climate change, as we've discussed, and the sustainability agendas on their assets. And based on that poll, we would really recommend that after this reporting cycle, or if you've got time before you report, really start to have those discussions internally and think about the changes you might need to make, maybe tweaks, maybe more substantial, but think about those changes you need to make to your impairment modelling.
Okay, so this next slide's talking about disclosure. This is the final section, so we're on the home straight here. And we've talked already about COVID-19 creating additional uncertainty for natural resources companies, and this has definitely shaken investors' confidence. So your reporting now should be about restoring that trust. And based on our experience from previous years, there's always been a lot of diversity in how well companies communicate. And being honest, even the best reporters are falling short in some areas. Now, I appreciate there's lots of explorers in the room, and geology and results of feasibility studies, these form the backbone of investment decisions. But after 2020, investors and other stakeholders are going to have more questions than normal that need answering. And we're also seeing more than usual, companies are going to market to raise new funds. So there's an additional need to compete for capital. So bring all these factors together. This is not the year to roll forward last year's financial statements. This is the year to better communicate how you've weathered 2020 and what your plans are going forward. So to help with that, on the screen you can see 4 tips. The first one's about telling an authentic story in your annual reports and using strategy as the main linchpin of the narrative, with all other elements of reporting linking to it. And this is because investors really care about the progress you're making against your strategic priorities and what's going to impact on progress and how it's being measured and what the risks are. But all too often, we're faced with reports that really don't answer these questions clearly. The second point's on risk, and here too often we see very generic disclosures. And there's a sort of a mindset, which is we'll just throw the kitchen sink with a general list of risk factors that aren't contextualized and they're not explained. So this year, providing more balanced disclosure of risks and how they're being addressed is more critical than ever. The third point builds on the previous 2 points, and I'm not proposing here more words and longer annual reports, quite the opposite. I think less is more here, and pictures paint 1,000 words. So try and bring in some diagrams. And if you're looking at reams and reams of sort of black and white text, it's not exciting, and your investors maybe won't be so inclined to read it. My final point is a mindset one. So don't think of your annual report as a regulatory filing document. Think of it as a means to communicate effectively and give you a competitive edge. And I'll leave you with a question. Does your annual report look very different to your investor presentations? And if it does, why? Because both documents are telling the same story. Okay, so with that final thought, we'll move on to the next poll. Which statement best describes your situation in respect of your 2020 annual report? Okay, so the result doesn't seem to be changing much. I'm pleased to say we're very confident about the quality of the great annual reports that you'll all be producing. So that's good to hear. Further question, I suppose, is this year, all working remotely, is it going to be a more challenging exercise this year to pull together the annual report? No change. What's everyone's thoughts on how this is going to work this year remotely? I haven't thought about it yet.
Oh dear, that's slightly contradictory to the poll response. Oh, already decided. Already decided.
Well, I'm sure we will be reading lots of them in the coming months. So we look forward to hopefully agreeing with you that they're all going to be in good shape. So we'll now move on.
Oh, Laura's got a question. Pete.
Yeah, it's just an observation, really. So given we obviously see a lot of different annual reports from all of our different clients, do feel free to share any COVID-related disclosures or any disclosures with us in advance at your planning stage. More than happy to review or input on those.
Yeah. Okay, so applying the RETHINK model to disclosure. So we've already talked about, we see huge variation in how effectively companies are telling their stories in their annual report. Based on the poll we've done today, this audience is clearly leading from the front. But in any case, a challenge your company faces this reporting cycle is to explain what your company is doing to thrive after 2020 and everything that happened in the year. And this is strategically and operationally, and also to explain how you've reacted to the changes that have arisen and how they impact your business. So the leading companies are going to be in the realise phase, and they will have moved past just trying to ensure regulatory compliance. They're going to instead be using smart compliance to clearly articulate in their reporting the steps they've taken to rethink their strategy after last year and how it aligns with the new political, business, economic and social environment that we find ourselves in. Okay, that's all I wanted to say about disclosure. A few more comments have come in. No change at Union Jack, so that's good. 6-month process, which is very encouraging to hear. That's a very robust process. Okay, without any more questions, I'll now hand over to Louise to wrap up.
Thank you, Pete. So we have reached the end of the workshop this morning. Thank you so much for joining us and for your participation. We hope you found it useful and some of the discussion insightful, and that it will help your reporting in this 2021 reporting season. As we've said throughout the workshop, if you do have any questions or comments or things you'd like to pick up from the workshop, don't hesitate to get in touch with either myself or Pete, and we will certainly look to help you. Thank you very much again for attending, and have a lovely day.